Every investor dreams of finding that one golden opportunity, the one that doubles or triples in value while everyone else hesitates. But here's the question. How do some people always seem to pick the right investments, no matter if markets are crashing or soaring? Today, we're decoding exactly that. The proven signs, numbers, and hidden signals that the smartest investors use before they make a move. The foundation. What makes an investment good? Before you chase profits, learn what good really means. Most beginners think a good investment is one that simply goes up, but professionals know that's not enough. A truly good investment balances returns, risk, fundamentals, and exit strategy. It performs not just in the sunshine of a bull market, but also in the storm of a crash. Ask yourself, does it generate consistent returns over time? Does it protect your capital if the market turns? Does it have real measurable fundamentals behind the hype? Good investments don't rely on hope. They rely on data, patience, and discipline. That's why experienced investors never say, I got lucky. They say, I was prepared. And by the end of this video, you'll know exactly how it's prepared too. 2. The numbers never lie, core metrics to check every time. Do you want to separate hype from truth? Follow the math, not the noise. Let's break down the core signals that tell you whether an investment is solid or shaky. Return on invested capital, ROIC. This shows how efficiently a company turns its capital into profits. A high, stable ROIC means the business isn't just growing, it's growing smart. Debt to equity ratio. Debt is a double-edged sword. In good times, it multiplies profits. In bad times, it kills companies. A healthy investment has manageable debt, meaning it can survive when interest rates rise or demand falls. Free cash flow. Forget fancy accounting. Cash flow is truth. If a company consistently generates positive, growing free cash flow, that's real strength. It means it can fund itself, pay dividends, and weather downturns. Profit margins. Watch for businesses that keep or expand margins even in tough markets. That's called pricing power, and it's a huge sign of long-term quality. Valuation ratios. P/E, P/B, PEG. A good company can still be a bad investment if you overpay. Compare its valuation ratios with peers. A high P/E may signal overconfidence. A fair or low P/E in a strong business often hides opportunity. Risk versus reward. Ask, how much could I lose if I'm wrong? A smart investor seeks asymmetric returns. Low downside, high potential upside. These metrics form your investment compass. When everything looks uncertain, the numbers will always tell the truth, if you know how to read them. The market safety has how to spot value in every environment. Every market hides opportunity if you know where to look. Markets move in cycles, up, down, sideways, or chaotic. But your ability to spot a good investment shouldn't depend on luck or headlines. In a bull market, confidence is high. Everyone's buying. That's when discipline matters most. Stick to fundamentals, not hype. Avoid overpriced assets that rely on forever growth. Buy strength that's still fairly valued. Companies with real earnings, not dreams. In a bear market, fear is everywhere. Prices crash. But for disciplined investors, this is when true bargains appear. Focus on strong balance sheets, low debt, and stable cash flow. Buy quality that's temporarily discounted, not junk that's permanently broken. In sideways or uncertain markets, go for income and consistency. Dividend stocks, REITs, or stable assets that generate steady yield. Here, small consistent gains beat volatile bets. During inflation or rising rates, choose companies that can raise prices without losing customers. Real assets, energy, and quality businesses with pricing power thrive. A good investor doesn't predict the market, they adapt to it. They rate the FLAGS, what to avoid at all costs. Sometimes the best investment decision is walking away. Spotting a bad deal early is just as powerful as finding a great one, and every successful investor knows this skill can save years of regret. One of the biggest red flags is an overhyped story with no real cash flow. You'll often see companies with projects painted as the next big thing, but when you look closer, the numbers just don't add up. No income, no customers, no path to profitability, just hype. Then there's sky-high debt disguised as growth financing. It sounds fancy when a business says it's borrowing to expand, but if the debt outweighs their ability to repay, it's not expansion, it's a ticking time bomb. Be cautious of firms that rely heavily on loans just to stay afloat. Another major warning sign is unproven management that promises more than they deliver. A great idea is worthless in the wrong hands. Always check the leadership's track record. Have they built anything successful before? Or do they just talk big with no history of results? Next, beware of valuations disconnected from reality. If a company's worth is based purely on hype or future dreams rather than real performance, the crash is only a matter of time. When numbers seem inflated or inconsistent with industry standards, that's your cue to step back. And finally, watch for investments that depend entirely on perfect conditions, constant demand, low interest rates, or endless market optimism. The real world doesn't work like that. When success hinges on everything going right, it usually doesn't. Your personal investment blueprint. You don't need a crystal ball, just a process that never fails you. Here's a step-by-step checklist that works in any market. Use it every time before you invest. Define your investment thesis. Ask, why am I investing in this? If you can't explain it in one clear sentence, don't do it. Check the numbers. Look at ROIC, debt levels, margins, cash flow, and valuations. These are your hard facts. Evaluate the people. Strong management can turn average assets into great ones. Weak leadership destroys value fast. Study the environment. Is the timing right for this asset? Some sectors shine in recessions, others crash. Context matters. Assess the downside. Imagine the worst case scenario. Can you live with it? If not, it's not your investment. Know your exit. Liquidity is key. Can you sell when needed, or are you trapped? Match it to your goals. Align every investment with your risk tolerance, cash needs, and time horizon. This checklist isn't about perfection. It's about consistency. Follow it, and you'll start thinking like an analyst, not a gambler. The secret, ROIC, how pros think differently. The smartest investors profit long before they sell. Here's a principle most beginners miss. You don't make money when you sell, you make it when you buy. That means the moment you choose an investment, based on facts, discipline, and valuation, your profit potential is already locked in. If you bought well, time becomes your ally. If you bought poorly, time becomes your enemy. This mindset transforms how you invest. It's no longer about predicting short-term price moves. It's about building long-term certainty. Patience isn't passive, it's strategic. Great investors aren't fortune tellers. They're architects, building wealth brick by brick, by decision. The 9 in the SAT, staying calm in chaos. Your emotions will cost more than any bad stock ever could. Markets rise, markets fall, but the biggest risk is the volatility. It's your reaction to it. When fear rises, discipline disappears. That's when people sell too soon, chase trends, or panic buy. But the calm investor wins because they follow principles, not feelings. They don't ask, what's the market doing? They ask, does this still meet my checklist? If yes, they stay. If no, they move on. That's how you turn chaos into control. The question that tests your investing mind. Now it's your turn to think like an investor. So here's my question for you. If you could only use one single metric to judge any investment, which one would it be? Would you trust cash flow, valuation, or management quality the most? Drop your answer in the comments below. I'll be reading them. And if you learned something new today, make sure you subscribe, hit the bell icon, and share this video with a friend who's trying to grow their money in 2025 and beyond. Remember, markets will always change. Discipline never goes out of style. The investors who stick to process, not prediction, don't just survive the storm, they own the ocean. Till next time, stay curious, stay smart, and invest with purpose.